Hey, welcome to session 9, reading financial statements like an analyst. So far, till session number 8, I think we have had enough of the sessions where we are able to actually, apply our knowledge and read. So this particular session is going to be very powerful. It's going to be a powerful shift. Most people look at numbers, right? But what's very important for them is how they actually look at those numbers. Okay, very few people understand what those numbers actually mean. Today, what you're going to learn is how to open any annual report and within just 10 minutes identify what really means. We're going to learn the 5-minute scan technique, the 20 question analyst check, uh, red flags that indicate manipulation, and how to judge whether profits are. By the end of the session, you will not just read financials, you'll think like an analyst. So let's get started. Let's quickly recap what we learned earlier. First, we'll start with the future value and then present value. So future values formula was FV is equal to PV into 1 plus R to the power N, where FV is the future value, PV is the present value, R is the rate of interest, N is the number of periods. It can be months, it can be years, whatever. Now, these formulas help us understand how money moves across time. The second thing that we learned was the rule of 72. That is, how many years it will take for your money to actually double. What you need to do is just take 72 and divide by the rate of interest. For example, if the rate of interest is 12%, you will actually take 6 years to double your money, right? The third thing that we learned was CAGR, compounded annual growth rate. And the formulas was very simple: ending divided by beginning, raised to the power, if you remember, right? So that is what we actually studied: 1 plus 1 divided by n minus to the power of minus 1. So this is what we actually learned. Now, study AI example shows 599% growth, but CAGR tells us the true compounded rate. Today, let's build on this because investors don't just, calculate numbers, they interpret them. Now, let's quickly run down with our agenda. First is a real story where profit was high, but stock crashed. Then the 5-minute scan, as I mentioned earlier. Then the 20 question check. Then red flags. Then we'll talk about the quality of earnings. And finally, a real analysis of study AI. By the end, you will be able to scan any company quickly, identify risks, and form a clear judgment. Now, imagine this. Let's start with a situation that looks simple, but completely changes how you think about financial statements. A company reports a profit of rupees 500 crores. Now, if you hear this, your first reaction is that's a great company, profitable, growing, strong. But what actually happens next is shocking. The very next day, the stock crashes by 30%. Now, wait a minute. This is extremely important. Just ask yourself, if a company is making 500 rupees gross profit, why would investors panic and shell? So, is the market irrational, or is there something deeper going on? And this is where most people make a mistake. They believe the headline, they see profit, and they assume that it's all success. But professional analysts do something very important. They don't just read the headline or right, they go deeper. They ask questions like, is this profit real? Is this profit backed by cash? Is this business actually healthy? Now, there are three important questions. And when they looked deeper, they saw something completely different from the headline showed. And that is exactly what you're going to learn in this session. Because once you understand this, you will never look at profit numbers the same way again. Let's take that same company and go beyond the headline. On paper, everything looks strong. Revenue 8,200 crores, net profit 512 crore, EPS is 42, right? That's earnings per share, what you actually call. So if you stop there here, you will conclude it is a great company, but analysts never stop here. As I actually mentioned, okay, one level deeper, they actually go and They will now read the cash flow statement and balance sheet. Okay. So this is where the real story starts. Let's start with the operating cash flow, which is, you remember CFO, this is what we discussed earlier. So that is 340 crores. Let's understand this carefully. Right. What actually CFO tells how much actual cash the business generated from operations. Right. Now here, CFO is negative, 340 crore. Okay. Let's compare. So your profit is 512 crore, which is plus, but cash flow is minus 340 crore. There's a huge mismatch. Now think about this in simple terms. The company is saying we made 512 crore profit, but in reality, cash is going out of business. So you remember the earlier session where we discussed about this, right? Your cash flow is the end, which is very important. Your company may be profitable, but it may not have any cash, right? So the question is, where's the cash then? This is your first red flag. Then comes the receivables. Receivables increased by 1,800 crores, right? Remember what are receivables? Receivables are money customers, owe to the company, right? That's very important. So so this in particular increase of 1 crore, 1,800 crore means the company has booked revenue, but has not collected the cash yet. Let's simplify. Imagine you sell a product for, let's say, 100 rupees. But the customer says, I will use the product and I'll pay you later. So, that's sometimes, it's the model, right? You take your bills, for example, mostly. You take the service, but you pay it later, right? You still record 100 rupees as revenue, but you don't have the money. Now scale this up. When you start scaling this up, you may end up getting something like, 1,800 crore. This could be an uncollected revenue. It will come, but it has not come yet. Okay. That explains why profit is high, but cash is missing. So this is your second red flag. The third is the debt that is increased by, let's say, 2,200 crore. Now ask, if cash is not coming in, how is the company running operations? Okay. What's the answer? By borrowing money. So debt increased by 2,200 crores, right? That means the company is taking loans just to survive day by day operations. This is really, really dangerous because a healthy business generates cash. A weak business depends on debt. And this is your third red flag. Please remember one thing. The most successful, not successful, the peaceful person on this planet would be somebody who has not taken any debt. Trust me, right? So auditor note can be then, going doubt, doing concerned doubt. All those things will actually come out. And this is the most serious point. The auditor, who is actually an independent professional, is saying we are not sure this company will continue operating, right? And this is called a going concern warning. This is called a going concern warning. So this is a phrase that you might have read in newspapers or in news. So when this appears, markets react immediately because this is not an opinion. It's a professional risk signal. This is your fourth and biggest red flag. Now you connect everything. Let's pull all pieces together. Profit 512 crore looks good. Cash negative. Cash flow, I mean. Receivables very high. Debt, it's increasing. Auditor is signaling. Ask yourself, is this company actually healthy? The answer is capital no. And that is exactly what the market understood. That is why the stock went down, crashed 30%. So the key analyst checks from the side would be very simple. First is look at the P&L versus, the cash flow. There's some divergence that you're actually going to see. If profit is rising, but cash flow is not, profits may not be real. Look at this receivables versus revenue. If receivables grow faster than revenue, companies actually booking revenue without collecting cash. Just use this common sense, right? So please understand, whatever sheets that you prepare and you make in finance, they're just not numbers. They could be very simple math, but they're just not numbers. They are the ones that decide your present and your future of the business, helps you take decisions. Then comes the auditor flags. Words like, going concern, qualified opinion, emphasis of matter, right? These are not small notes. They're real signal, serious, warnings. So the insight is very simple. The numbers on the front page are designed to impress, but the numbers inside the statements reveal the actual truth. And you have to read between the lines. And your job as an analyst is very simple. Don't stop at profit. Okay, follow the cash, because profit is accounting, cash is reality. Now that you have understood this, right, uh, which is misleading, surface level numbers can be, the question is, how do I quickly analyze any company without getting lost in hundreds of pages? Now, because real annual reports can be 200, 300 pages long, that could be the question. And as founder, investor, analyst, you don't always have that much time, right? Today, of course, you can give it to any AI and it will browse that information. Things are faster, but still you'll have to use your brain. So that's why we use something called the 5-minute scan technique, right? And what the technique is, it's a structured way to get 80% understanding of your business in just like 5 minutes. Not a perfect analysis, of course, because uh, if you have to match every number, you have to read those 300 documents. I mean, even AI can't help you that because it can make mistakes. Okay. So think of it like a doctor doing an initial diagnosis, right? Before running detailed tests, right? So how the 5 minutes are divided, actually, we break the analysis into 5 parts. Let's try to give 1 minute each. When I say 5 minute, it can also go up to 10 minutes, depending on how fast you're reading this. But let's assume 1 minute for each. First one is from the profit and loss statement. Just look at the profitability, right? The second one is margins will actually explain to you the efficiency. In the third minute, look at the balance sheet. It's going to tell you the risk and stability. Then look at the cash flow statement, the reality check. Then you remember a lot of ratios we saw. Quick validation will happen through them, right? So by the end of these 5 minutes, right, you should be able to answer three things. Is this business profitable? Is it efficient? Is it risky? And in fact, the fourth one that you can add is the profit real, right? So that's very simple. And why this is going to work? It's very simple, because financial statements are just not random. They always answer, these questions, right? So very simple, right? So we can go ahead with that. Okay. So let's quickly move to this one. Okay. Um, we'll start with the first one, that is revenue trend, and let's understand the gross margin from the P&L. Right. What was the first question? Is revenue growing year on year or not? That's the question. The second was, what is happening to the gross margin, right? Is it stable, expanding, or like contracting? Now, because a shrinking gross margin is often the first sign of the trouble, right? You need to actually look at the formula. So gross margin, again, is revenue minus the COGS, right? Divided by the revenue. Obviously into 100, this percentage that you calculate. So revenue in case of study AI, let's take the old one, which is 53 lakh, 53.8 lakh. The COGS was 8.4 lakh, right? What was the gross margin? 84.4%, very strong margin. Look at the second number, that's the EBITDA, right? Margin and the net margin. Okay, so EBITDA is what? It removes the impact of financing and taxes. So it tells you how the core business is actually performing. So net margin is the bottom line, right? Revenue start at number one because it comes, so it's a top line. Everything gets filtered out minus, and it's a bottom line, right? So what's left after everything? Now the formulas are very simple. We know the formula, right? EBITDA revenue minus COGS minus operating expenses, excluding depreciation, amortization. Net margin was, of course, net profit divided by revenue. Okay, so both of these should be ideally stable or improving over time. Now look at the debt to equity or current ratio from the balance sheet. Okay. The first one is, we'll move to the balance sheet now, right? Debt to equity. So total debt divided by the equity. If this is 2 times in a non-financial company, it needs explanation. Second, that is the current ratio. Current assets divided by current liabilities. Very simple. If this is below 1, it means the company may struggle. Okay, because assets should be more, liability should always be less, 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 even zero, right? To meet short-term obligations. Take the example. In case of study, it's very simple, 2.12 times, which is very healthy current ratio. The next one is the operating cash flow, CFO versus the net profit. Okay. Now go to the most important statement, is a cash flow statement. Compare the CFO, cash from the operations, with the net profit. Ideally, CFO should be close to or higher than net profit. Now, if there's a large gap, it raises concerns about earnings quality. And if CFO is negative, that's a serious warning, right? In case of study AI, your CFO is 45 lakh, net profit is 43 lakh. So the cash is, higher than profit. The difference is explained by non-cash adjustments, which is a healthy sign. And the last minute, right? The trend check, 2 to 3 year view, you can actually do. Just zoom out. 1 year is just a data point. 2 years show actually a trend. 3 years actually tell a story. That's how we understand. So look for consistency across all three statements. Are margins stable? Is cash flow growing? Is debt under control? Now here is a point. At the fifth minute, if I'm saying you have to look at the last 3 months, you may have 3 years, you may have a question: what if the company has just completed 2 years or 1 year? Obviously, it's at a building phase. You may not look at all these things. You may directly look at how the internal performance is, because it will not reach to that stage of where the stock prices will go up. Right. Today, in the field of AI, in 6 months, things are booming up like anything. And that's where the trend has actually got changed. They see month on month what's happening, what is the technological development, and how the future looks like. So when you see consistent margins, growing cash flow, and stable debt, you're likely looking at a quality business. But if the trend keeps breaking, right, there's where you investigate deeper. Okay. And that's it. So in just 5 minutes, you have already understood most of the company. Everything else is just doing, deeper. Fine. So now we move to something very powerful, a simple but disciplined way of thinking like an analyst. Instead of guessing, instead of going by gut feeling, we use a checklist. Now, a simple but disciplined way of thinking like an analyst. Instead of guessing, instead of doing by gut feeling, we use a checklist. Now this checklist contains around 20 questions, important questions, that help you evaluate a company properly, right? And the way you use it is very simple. For every question, you mark yes or no, or maybe you can actually add don't know also, right? And here's the most important part: don't know is not a comfortable answer. It's a signal. It means you need to go back, read more, and understand better. Because real analysis is not about quickly saying this company is good or this company is bad. It's about building clarity, one question at a time. When you go through these 20 questions, you start seeing patterns. You start noticing where the company is strong, where it is weak, and where things are unclear. And that is a shift. So from guessing to structured thinking, right? The more yes answers you have, the stronger the company looks. The more no and don't know, the more careful you need to be. So over time, the process builds confidence, right? Because you're no longer depending on opinions. You're relying on a system. And that's exactly how real investors actually think. So we move to the first set of questions. Um, Here, what you see are the 10 questions, right? Focused on P&L and the quality of revenue, right? And so let's start. Question one is revenue growing consistently year on year? So if the revenue is lumpy or declining without a clear explanation, this is a red flag, because strong foundation, right, businesses uh, usually show predictable growth. The next question is growth margin stable or expanding? Right. If gross margin is declining, It may mean, pricing power is weakening or input costs are rising. The third question is EBITDA. If EBITDA margin above the industry average, if it is below, it suggests that the company has a cost disadvantage compared to competitors. The next question is net margin improving over the last 3 years, in fact? Ideally, margins should expand as the company scales. If margins are flat or declining, that's a concern. Are exceptional items distorting profit? If yes, see repeated one time gains or losses, right? That's a red flag because they're no longer, truly one time. The next question is, what is the revenue recognition policy? Policies like percentage of completion or bill and hold are considered high risk because they allow revenue to be recorded before cash is received, right? So, yeah. Next question is EPS reported as basic or diluted? So, diluted EPS actually includes the impact of stock options and warrants. So, as an analyst, you should always focus on diluted EPS. We'll definitely talk about that in detail for a right. So, this is actually for more realistic picture. Then, are related party transactions disclosed? If there are large transactions with related parties without a clear business reason, that raises governance concerns, which means something is going wrong, right? Is other income a large percentage of growth? If other income is more than, let's say, 20% of total profit, it may mean the core business is weak and profits are coming from non-operating sources. Has the auditor given a clean opinion? If you see terms like qualified opinion, adverse opinion, going concern, all that, that's a serious red flag, serious warning. Okay, so these 10 questions actually help you understand one thing very clearly, not just whether the company is growing, but whether that growth is real, sustainable, and trustworthy. Okay, so it was all related to the P&L part that we see. Now we'll see the balance sheet and cash flow. Okay, these questions help you understand not just performance, but financial strength, risk, and stability. We'll start with question number 11. Is the current ratio above 1.5 times, right? And if it is below 1, then the company may not be able to meet its short-term obligations, right? That's a high risk. So you will not be able to pay salaries, people will leave, and there are so many other things, right? Is debt to equity, below 2 times? If it is above 2, in a non-financial company, it signals over leverage. The company may be too dependent on debt, right? The next question is goodwill a large percentage of total assets? High goodwill usually comes from acquisitions, which means you need to check whether that value is real or may need to be written down later. Are inventory days increasing? If inventory is rising, it means products are not selling and stock is becoming now an obsolete and it's a big burden, right? Are receivables days increasing? Okay, this means customers are taking longer time to pay or revenue is being recognized aggressively. Is operating cash flow positive and greater than net profit? If CFO is negative despite profits, it raises questions about earnings quality. Now, is operating cash flow consistently above capital expenditure? In other words, is free cash flow positive? If free cash flow is negative every year, the business depends on external funding to survive. Okay, we saw the 3 types of cash flows: CFO, then CFI, and right, and one through the financing part, the investment part, right, that we actually saw. So the business depends on external funding to survive. Then comes is the company self-funding its growth? If the free cash flow is negative and debt is increasing, then growth may not be scalable, right? Are dividends being paid from profits or from debts or from debt, in fact? So if a company borrows money to pay dividends, it's actually destroying its value uh, instead of creating it. Then has return on equity, ROE, improved over the last 3 years? If ROE is declining despite stable profits, it may indicate inefficient use of capital or dilution, right? So these 10 questions now complete, and together overall we have completed from the two slides 20 questions. And these help you evaluate one thing very clearly, not just whether a company is growing, whether it's financially strong, disciplined, and sustainable. Okay. So here is the next question: 10 warning signs that numbers may not be real. And this is what we're going to talk. Okay. So we come to one of the most critical parts in the financial analysis, the red flags. These are warning signs. They don't automatically mean fraud, that's to be very precise, but each one demands an explanation before you trust the numbers, right? Red flag. Okay. So now we come to one of the most critical parts of the financial analysis. That is red flags. Let's discuss. These are warning signs. They don't automatically mean fraud, but each one demands an explanation before you trust the numbers. The first red flag is CFO consistently, below net profit. This means profits are being reported, but cash is not coming in. A classic sign of aggressive accounting or inflated receivables. Yes, you're actually saying that I've got a lot of customers and they're yet to pay, and you're just showing that revenues are really, really going high, but there's no cash in the bank. Now, red flag two, receivables growing faster than revenue. If revenue grows 20%, receivables grow 60%. Bad news. If that's the case, the company may be booking sales that are not being collected. I'm not sure whether this is a kind of activity which may be treated as fraudulent. Red flag three, which is auditor resignation or frequent, changes. If an auditor resigns mid-year or the company keeps changing auditors, it means something needs closer attention. The red flag four is very simple. It's related party loans to promoters. If the company is lending money to promoter-owned entities, especially at low market rates, that is capital leakage. Red flag 5, revenue surges in quarter 4 every year. This may indicate revenues being pushed into the last quarter just to meet targets. Red flag 5, inventory rising while revenue is stagnant. Products are sitting unsold, which signals demand issues or possible overstatement. Red flag 7, frequent restatement of financials. If past numbers are being corrected repeatedly, it means the earlier numbers were not reliable. Red flag 8, high capital expenditure without matching revenue. Large investments, but no proportional growth in revenue. This raises questions about where the money is going. Red flag 9, promoter shares pledged above 50%. If promoters have pledged their shares heavily, it creates risk of forced selling and sharp stock declines. Red flag 10, profit margins consistently higher than all peers. This could mean the company is exceptional or the numbers need deeper scrutiny. Closing line for slide. Very simple. None of these guarantee fraud, but every single one of them demands a question. Why? And that question is what protects you as an analyst. Now let's pause for a moment and ask a very important question. Are these profits real or just accounting? Because up until now, we have looked at revenues, margins, growth. But here's the truth, not all profits are equal. Two companies can show the same profit, but one is generating real cash, the other one is just showing numbers on paper. And that difference is what separates a strong business from a risky one. High quality earnings are simple, they are backed by cash. Low quality earnings are different, they come from accruals, estimates, and accounting adjustments. And as an analyst, your job is not to get impressed by profit, but to ask how much of this profit is actually real. And when you use the term real, it should come from the cash that you have in your bank account or the company's bank account. Because in the end, cash sustains a business, accounting cannot. And now let's learn how to actually measure this. Let's ask this question. Are profits real or just accounting? Let's learn how to actually measure it. And for that, we use something called the accrual ratio. Now, what is the accrual ratio? The accrual ratio tells you how much of the profit is not backed by cash. In other words, it separates the real earnings from accounting adjustments. And the formula is very simple. Accrual ratio is equal to net income minus operating cash flow minus investing cash flow. So it's very common sense. You take the net income, subtract the cash flow, which is the operating cash flow, and you subtract the investing cash flow. Okay, right? This is very important, and not the financing one, because financing one is actually getting added, right? That's total assets. Then comes the next part. Each part very simply. Let's break this down. Net income is equal to profit shown in profit and loss. Operating cash flow is equal to actual cash generated from business. Investing cash flow is money spent on investments like equipment, assets, etc. We've already seen this. So total asset will be equal to size of the company. So essentially, we are asking how much of this profit is not supported by actual cash relative to the size of the company. You just apply this to the study AI exam. Accrual ratio is minus 4%. And what does this actually mean? A negative accrual ratio means cash flow is actually higher than accounting profit, which is why it's a very good sign. It means the company is not inflating profits, it's generating real cash. How to interpret actual ratio? Negative, let's say, like minus 4%. Excellent quality earnings, in that case, will be cash is always more than profit, business is strong, right? If it is around zero, we call it as neutral. Profit and cash are aligned. But if it is positive, and that too very high positive, so warning signal, right? Profit is coming from accounting and not cash. Why this matters so much? Because companies can manipulate profit, but cash is much harder to manipulate. That's why serious investors always check this. One powerful line to remember: the higher the cash backing your profit, the higher the quality of your earnings. Let's move to the next slide, right? What we're going to do is we'll bring everything together here and apply the full checklist to study AI year 2. And this is where analysis becomes decision. Let's start with revenue growth. The company has grown from 7.7 lakh to 53.8 lakh. Now, this is a 599% year-on-year growth. This is exceptional, marvelous. But as an analyst, you may also stay aware such high growth can sometimes be due to low base, right? So look at the gross margin, which is 84.4%. This is very strong. It clearly indicates a digital product business with very low cost of delivery. Net margin, look at it's 80.4. This is also exceptional. It shows that as revenue scales, the fixed costs are not increasing at the same pace. And this is what we call operating leverage. Moving to the financial stability, current ratio, we've discussed this all multiple times. So 2.12 times. And this means the company has more than double the assets compared to its short-term liabilities. So it is financially comfortable in short term. Now, debt to equity ratio is 0.15 times, much closer to zero. Very low, right? So it tells you the company is almost debt-free with a very clean balance sheet. Now, the most important check, cash flow versus net profit. Your CFO is 45 lakh, net profit is 43 lakh. Since cash flow is higher than profit, it confirms high quality earnings. Okay. The free cash flow is 44.6 lakh. That's an 83.4% FCF margin. And this is world class for a digital startup. It means the business is not just profitable, it is generating real surplus cash. Now, receivables, which is zero. Payments are settled within 3 days through Razor Pay, let's say. And this means there's no receivables at all. And the risk is not there. Let's try to check the red flag. Okay. CFO, is it negative? No. Receivables growing faster than revenue? No. Auditors' concerns? Not applicable yet. Related party transactions? No. Quarter 4 revenue surge? No. Consistent. So no major warning signals. So final analyst verdict. Putting everything together, strong growth, exceptional margins, clean balance sheet, and cash-backed earnings, this particular confusion that arises through all this is not there. Okay. Then study AI year 2 financials, if you look at, are really, really high from all this. And this is the real takeaway from the session. You don't judge a company by revenue or profit alone. You look at the full picture, look at the growth, look at margins, cash flow, and risk. Now, because that's how real decisions are made and how you can progress, you have everything with you. Very simple mental model that we're going to discuss called the key ratios, right? And these are very important, and every analyst must know, by heart. You can also call it as a quick reference card. So whenever you analyze any company, and these are the ratios you come back to, and we'll start with the profitability first, right? So gross margin is, calculated as revenue minus COGS divided by revenue. And you want this to be above industry standard. In case of study A, we saw it's been 84.4%. Look at the EBITDA margin. So EBITDA divided by revenue. Ideally, this should expand over time, showing improving efficiency. Net margin is net profit divided by revenue, right? So you want to be stable or growing. In case of study A, it's 80.4, which is exceptional. Then ROE, we discussed earlier, net profit divided by equity. A good benchmark above 15% is what treated. So this indicates, efficient use of capital. The second part is the leverage. Okay. Look at the financial risk. First one is debt to equity. It should be below 2. In case of study A, it's 0.15, right? Then interest coverage. Take the interest out. This is very important. So EBIT will be divided by your interest expense. And you want this to be above 3 times, meaning the company can comfortably pay its interest. In case of study A, it's around 100 times. It's above 100 times, I think. Very strong. The third one is, let's look at the liquidity. Short-term financial health. So current ratio, you have to calculate. Take the current assets divided by current liabilities. 1.5, which is above, the benchmark. So it's very healthy. Okay. And in case of study AI, of course, it's 2.12. We've always seen. If you have to calculate quick ratio, very simple. Take the current assets minus inventory and you divide by current liabilities, right? Fourth one, if you want to understand, that's efficiency. And because how efficiently the business operates. Take the receivable days, right? So receivables divided by revenue multiplied by what? How many days in a month? 365, right? So lower is always better. Here the receivable is around 3 days, which means cash is collected very quickly. Asset turnover, so revenue divided by total assets. And you want this to show an improving trend. In case of study A, it's 1.12 times. All in all, for study A, it's the best. Okay. So what's your takeaway? You don't need hundreds of ratios. If you understand these few, you can analyze almost any business with confidence. Profitability tells you how much you earn. Leverage tells you how much risk you carry. Liquidity tells you whether you can survive. Efficiency tells you how well you operate. And together, they give you a complete picture. So let's recap. First, the 5-minute scan. In just a 5 minutes, you can understand most of the company's story by focusing on revenue growth, gross margin, debt to equity, cash ratio, and cash flow versus net profit. These five alone give you 80% of clarity before you even go deeper. Then we had the 20 question checklist. The 10 questions help you understand the P&L and revenue. This we discussed the first. Remember, I think probably slide number 9, right? And then there was another 10 questions related to balance sheet and cash flow. Okay, you all answer them, right? If you see a no or you cannot answer, this is a signal to investigate further. The third one was we saw something called the 10 red flags, right? Things like cash flow below profit, receivables growing too fast, auditor changes, related party transactions. Okay, so none of these, right, automatically mean fraud, but every one of them demands an explanation. And finally, it was something called the quality of earnings, the most important idea of the session. High quality earnings are backed by cash. Low quality earnings are backed by accruals and assumptions. In case of study AI, the accrual ratio of -4% shows strong cash backed earnings. Right. So from today, you just don't look at profit. You ask this very simple question: is this profit real? And that one question will completely change how you analyze your business. Thank you so much. I think this is wonderful. Okay. So maybe what we can do is read one real Indian company's financials, right? Uh, you can go to Screener or BSC or NSC, download the actual, the annual report of any listed company. Start with something familiar. Start with Zomato, Nika, or any other brand, whichever you feel you like or it's there. Then open the P&L first. Apply the 5-minute scan. Ask yourself, is revenue growing? Is gross margin stable? Is net margin improving? Move to the balance sheet then. Check the current ratio. Check debt to equity. Look at goodwill. Is it significant? Step 4. Now go to the cash flow statement. Is operating cash flow positive? How does it compare with net profit? And most importantly, is free cash flow positive? So run your full 20 question checklist. Mark each answer is, let's say, green means pass. You take the red light signal, traffic light signal, what you can say. So green, pass, yellow needs investigation, red means concern. That's how you can put the legends. And finally, write down 5 observations about the company's financial health uh, and give a clear verdict, whether it's strong, moderate, or weak. The tools that you can use is there's a 20 question checklist, ratio calculator, red flag counter, quality of earnings calculator. All these are there. You can actually just see. There's a link that I've already given in the previous videos, right? So these tools will help you actually analyze faster and structured. And what's the analyst tip of the week? One final tip will be always start with a cash flow statement, not with a profit and loss, because the profit and loss is prepared by the company. But cash flow reflects reality. Cash either came in or it didn't. CFO is the truth. Net profit is an opinion. Yeah, do this once and everything you learned today will become real. Maybe do this 5 times. Okay, so this is very important. And I think in the next session, this is what we're going to do. How long can a company actually survive, right? We'll talk about burn rate and runaway. We'll discuss the difference between gross burn and net burn, of course. We'll we'll do the runway calculation. That's going to tell you how many months you have before your bank balance hits zero. And finally, the runway survival plan, which is this is important. Okay. So because startups, growth is important, but survival comes first. Wonderful. So I complete this session number 9 round. And yeah, that's it. Thank you so much. We're signing off.